Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. And someone wanted to talk about the real estate to gold ratio. I talk a lot in ratios. And the reason I talk a lot in ratios is you have to figure out the value of something against something else. The dollar is not a good measuring stick to indicate value. So if something goes up 5%, doesn't matter what it is. Goes up 5%. Did it go up a lot? That's the question that I asked you guys. Did it go up a lot? Did it really go up 5%? Now, what if everything else in this world went up at 30%, but this one only went up 5%? That's saying that it actually went up less than everything else. So on a relative basis, that asset or whatever it is went up less and lost purchasing power gains against everything else. So as an investor, if you want to make money and invest in assets, you have to look at ratios because what it does is it tells you relative value. And relative value is what you're looking for your investments. You want to go in the undervalued asset, wait for that undervalued asset to appreciate against other assets so you can buy more of those other assets. That's the whole point of investing. The whole point is to increase your purchasing power gains. And everything gets so convoluted that, and when inflation kind of comes into the system, everything kind of goes up. And you're like, well, what went up the most? What went up the least? Where should we be? You should be in the undervalued assets that work well under inflationary periods. Well, anyway, so that I have an entire channel. I've got a whole bunch of videos on all that ratio investing analysis stuff. It does work very well. But these are for long-term time horizons. These aren't on a monthly basis. It's on yearly basis. So when you look at something and it's very cheap, it may take 10 years for it to become very expensive in the future. So this is an approach where you kind of pile in, you get your assets. You may be buying something for a couple of years, and then you wait a couple more years, and then you wait a couple more years, and then it becomes overvalued against all the other assets, and then you swap those assets to other undervalued assets. And you continually swap from overvalued to undervalued over time. And that's how you increase your purchasing power gains over time. It is literally that easy. So the next question is, well, what's cheap? And that's what we're going over. All these videos I have, I'm going over what's cheap. That's why I'm always doing ratio analysis. I'm showing you guys market updates. I'm showing you charts, graphs, all sorts of stuff. That is what's telling us what is cheap and the relationship of how they're moving from an asset to an asset. We want to be in an undervalued asset that's moving up against other assets. That's like the perfect scenario. And right now, the cheapest assets there's a couple very cheap assets. Oil is very cheap. Uranium is very cheap, very, very cheap. That's one that I really like. Silver is still somewhat cheap, and platinum is very cheap. So those are the ones that I'm focusing on. Those are the ones that I'm investing in. Copper is just, we're going to use so much of it that I don't know how they're going to keep up with copper. But one of the ratios, real estate to gold ratio, it's behind me right here. You lose me. This is the ratio for real estate to gold ratio, all the way from 1890 to 2020. And this is the real estate to gold ratio. This is the actual ratio on the right, I should say on the y-axis. So we are at about 230 ounces of gold can buy one house. And historically, that is incredibly cheap. Incredibly cheap. In fact, that ratio is cheaper than all of the 1800s, all of the 1900s, outside of in 1933, where it bottomed, the market bottomed at a home price index to gold ratio of 234, which would be, this is considered like a huge crash in real estate back here. And it was in the 200s. Again, we are in the 200s right now. And we got all the way down in 2011 to a low of 139, which means that 139 ounces of gold could buy a house. That is incredibly cheap for real estate. We are still in a very cheap area for real estate. And I know this seems weird. I get it. But the ratios don't lie. And here's the thing that's going to be kind of weird. I think that gold in relationship to everything else is dirt cheap. It's dirt cheap in relationship to stocks. gold is. So this valuation, we could see real estate just rip it. And it wouldn't be out of historical norms on a valuation basis when you value real estate against other things. Now I'm going to go to I'm going to do another long-term trends here. And hopefully we have a real estate to stock ratio, because this is going to look probably pretty bad. Stocks to real estate ratio. Here we go. 130 years. This is what I want. Now, if we look at this, look at that. Oh man, this is the stocks to real estate ratio. Stocks over time have been outperforming real estate, and just recently we've never been this high in relationship to real estate. So the S&P 500 has never purchased more home than today. What this is signaling is that real estate has never been this cheap in relationship to stocks. Stocks are vastly expensive, vastly expensive. I mean, look at 1929, and if we could draw a line through here, we're right kind of at that top. So stocks are incredibly expensive in relationship to gold, in relationship to real estate, in relationship to anything. So where I would not be, I would not be in stocks. No way. Remember, when interest rates go down, stocks go up. Their PE ratios and multiples go up. We are at a very, very expensive time for stocks. And I can't find a single chart where stocks are cheap to anything. They're expensive to everything. So that's the asset that I wouldn't want to be in. That's a high risk, overvalued area. Now, real estate is actually a very good value. I just showed you two ratios. I showed you the real estate to gold ratio where real estate was cheap, and I showed you real estate to stocks, and real estate's never been this cheap. So real estate is actually on the cheap side. And I know people, they look at the price, they look at all these things, and they say, well, if the price is high, it's like, hey, guys, everything else around real estate is flying up, like hyperinflation style in relationship to real estate itself. Real estate, I think, is just catching up. It's so out of balance in the supply demand that I think what's going to happen is that real estate's going to go far higher, and everything else around it's going to go higher with it. It may or may not go up at a faster rate than everything else to balance out all of these ratios. So one would argue that real estate is actually cheap, and it's cheap in relationship to gold. It's the cheapest it's ever been in relationship to stocks. So on a ratio basis, on a valuation basis, real estate's cheap, not expensive. If you guys like this presentation, give me a thumbs up. Leave comments below on what you guys think. And thank you for listening. This is Finding Value.